Our U.S. mortgage rate set a record low for the 9th straight week, making it cheaper to borrow and more attractive to refinance homes. But our next guest says there's more pain ahead for the housing market and that home prices will fall by at least another 5%, by the end of 2011. Steve Abrahams is the head of securitization and mortgage-backed securities research at Deutsche Bank, and he joins us here on set. Thanks so much for coming in. Appreciate you taking the time out of your day for us. Let's talk about the drops here. At least 5% you expect by 2011. You think there's some real problems, even though you can get a mortgage. I think Zillow said 4.28% yesterday.
Yeah, absolutely. I mean, borrowing rates are at record lows, but there really are bigger problems, I think, that housing faces right now. There's just, frankly, too much product out there, too many buildings that were built for homeowners back in the good old days, financed by very cheap subprime and alternative A financing. And now mortgage lending in general is tight. Although rates are low, it's harder to qualify for the lending than it was in years before. And on top of that, you've really got persistent high unemployment. It's just a very difficult situation.
You know, Steve, the housing market, safe to say, understatement of the year, that it's been a painful market. You say, though, more pain. I know you talk about 5% declines more in terms of prices. I mean, so as bad as we've seen, or you know, characterize what it's going to feel like in terms of the housing market going forward.
Well, a decline
because it's already been pretty ugly.
Yes, it's been ugly. I think from the peak in 2006, we're probably down nationally by about 30%. So I don't know if it sounds like good news, but a 5% slide from here compared to what we've been through may seem like a soft landing.
Well, and Herb Allison, the Assistant Treasury Secretary, came on with us, I think, last week and said, look, the pain right now isn't everywhere, right? You're feeling it in certain parts of the country more than others. So where do we see the big drops?
Well, the biggest drops have been in California, Nevada, Arizona, and Florida.
The usual suspects.
But going forward, do you expect those same places to take hits, or will they spring back while other places that haven't been hit hard yet?
Those areas have probably seen the worst of the news. In all likelihood, given foreclosure timelines and the supply of distressed properties that are in some East Coast markets, we're expecting the softness to come east instead of remain west and south. So the East Coast and the Northeast are probably going to be the softest markets over the next year or so.
I mean, there's just too many homes, as you mentioned, out there. And Matt knows I brought this up a million times because Bill Gross once had it on a website. He was referencing, I think he called a very smart man, but he said what we really kind of need to do, this guy suggested, was blow up 1 million homes. I mean, there is still so much supply
That probably wouldn't be nearly enough.
No.
Yeah.
Well, by our estimates, if you look at what the housing stock looks like today and the real effective base rate of demand, we think there could be something in excess of nearly 3 million houses. Some of them currently occupied by borrowers that may have weak hands or the old-fashioned form of financing. But as they decide to move, or if they get into problems with their mortgages, there really is no successor generation of homeowners financed with subprime or other affordability products to come in and buy those properties out of their hands.
You know, you make an interesting point that the November elections will probably bring some form or another of housing stimulus because it is such a big issue.
Yes.
And people want to get reelected. Until now, it seems like all the programs out of Washington have been aimed at sort of shouldering prices where they are. Do you think they should have policy out of Washington that just gets the deleveraging done and the stock through the system?
Well, it's difficult to see exactly how they would do it. I think they've taken a couple of runs at it with a light touch to refinancing various kinds of loans. I know in the last couple of weeks there have been rumors circulating that somewhere somebody is cooking up a plan to refinance all outstanding mortgages. That would definitely be a very dramatic effect. I think ultimately it would be more damaging to mortgage lending than it would be to facilitating a rebound in housing or the economy.
So what do you think they should do? I mean, what do you expect out of Washington come November?
Well, that's going to be a tough call, but I'll tell you, I think the single most important thing they could do would be to address the issue of unemployment. If you wanted to find one thing that would probably do the most for housing as well as a lot of other issues, that would be it.
All right. So a year from now, 6 months from now, we're still going to be talking, obviously, about the housing issue.
I think so.
You do? Okay. But I'm just curious. I mean, we talk about what the government can do. I mean, and you say the best thing is to target job programs.
Yes.
Bill Gross had talked about kind of nationalization of Fannie Mae and Freddie Mac. Do you think that's a mistake as you look at the housing market?
Well, I mean, implicitly right now, a lot of housing finance is nationalized, explicitly with Ginnie Mae, and then because of government backing for Fannie and Freddie, those basically are now sitting with a government backstop as well. And between those three programs, Fannie, Freddie, and Ginnie, they're funding more than 90% of all mortgage lending occurring in the United States right now. I think the challenge is to find a way of transitioning that mortgage funding back into private hands under the assumption, which I think most people would share, that you do want private lending. You don't want the government effectively to be the biggest mutual lender in the world.
The question, though, is if you have the government backing out of that position, do you have private lenders stepping up to fill the gap?
Well, I think what you'd be very likely to see is private capital coming back in if we can find a way of reconstituting Fannie, Freddie, or some other kind of GSE. Because I believe that there is private capital that would want to take some form of credit risk. I also believe that if you did that, you still would need the government playing the role of catastrophic insurer. A lot of investors would want to look to that ultimate government support. And this time around, I suspect it would be more like what you see in the banking business, where banks pay a fee to the FDIC for that kind of insurance. I'd look for the same thing in housing.
You know, a headline that caught Matt and my attention was when Karen Weaver, your predecessor, put out a report saying half of all U.S. mortgages would be underwater by 2012. Does that still seem likely in your view?
Does it look any better?
Well, I think Karen's prediction probably still holds. We think that there's about 14 million households underwater right now, going to someplace in the neighborhood of 20 million by the end of next year. And that's going to get you close to, let's call it, at least a third to 50% of the outstanding market. So that also poses a tremendous problem that I don't think as a country we've run into before. There are a lot of people who really aren't in a position to move, take a new job without finding a way of paying off that existing loan.
Yeah, it's definitely troubling. Hey, Steve.
Fortunately, you can walk in this country, right? I mean, in Europe, it would be an even bigger problem because there your mortgage follows you around to your grave.
Yes.
We've had a lot of viewers overseas writing in and say it's very different overseas.
Yes, I could imagine. Well, in some states you can try to do that, but very difficult.
All right. Hey, thanks so much for joining us. Pleasure having you on.
Absolutely.
Steve Abrahams there, head of securitization and mortgage-backed securities research at Deutsche Bank.